In this presentation, Sentinel Consulting discusses how small businesses can raise capital for startup costs, continuing operations, or perhaps even expansion. Some common forms of equity would include friends, family, or even yourself. Credit cards are also used for sources of financing, but be aware of some of the interest rates that could accrue with credit card usage. Small Business Administration loans, the SBA, or the Small Business Administration, will provide loan guidelines to their lending partners in order to reduce the risk of the loan to a small business because the Small Business Administration will ultimately guarantee that loan. We have the traditional bank loans and lines of credit. Angel investors can be involved, and typically those are affluent investors or perhaps a collection of affluent investors that then will provide debt or equity for startup organizations. Keep in mind when we use the word equity, that means some ownership or perhaps even control of that organization. Venture capitalists will provide funding for early stage, typically high risk, high growth startup companies that would occur after some initial seed funding. Venture capitalists will also require some equity and again ownership of the company, perhaps even seats on the board or other controlling interests. So how much funding do you need? Well, if you're an existing company, you can determine your projected sales using last year's sales figures. From that, you would subtract recurring costs such as rent, utilities, and wages. If you're a new company, you need to determine your startup costs such as inventory, supplies, advertising, promotion, etc. From your projected sales, then you would subtract startup and recurring costs and determine whether your company is going to be operating in a profit or loss for the year. That would determine then what your funding goal might be, whether that funding goal is going to be used to fund operations or perhaps some sort of capital expansion. Let's take a look at one of the sources of financing that we discussed earlier. In this particular case, let's talk about bank loans, and the same comments really could apply to SBA loans as well. But some of the factors that are important for bank consideration of lending you money would include capacity. What is your ability to make payments? Do you have that history in your past? Which one of the video series that we've included on our website as well is business credit. What sort of history of repayment do you have as a borrower? Character. What's your personal profile? Are there any character blemishes that you have that would make a bank officer reluctant to lend you money? And then lastly, collateral. Collateral are going to be assets pledged in the event that the loan does not experience repayment. One of the things that's important to consider for collateral is that collateral is generally factored. So what exactly is factoring? Well, once a business pledges collateral, such as real estate, business assets, or even stocks against a loan, the lender then factors or discounts the value of these assets in the event of liquidation of the collateral due to non-payment. When the lender would have to assume ownership of the collateral, they will attempt to sell it in order to recover the monies that were not repaid. However, the lender is not likely to recover dollar for dollar on the collateral's presumed value. So then what the lender must do is discount the value of that asset as a consideration of the collateral. So the important thing to consider is that the lenders are going to anticipate receiving less than the market value in the event that they have to liquidate it. So it's important then for businesses to offer, let's say, $2 of collateral for every $1 of a loan. Another important consideration when obtaining financing is the debt to net worth ratio, and that is the financing of lender investors relative to owner investors. Another way to look at that is how much skin in the game does the owner investor have? In startup businesses, as a guideline, lenders expect anywhere from 20% to 50% owner participation in the form of equity. So what that means for businesses is that they should expect no more than 2 to 5 times financing by the lenders relative to the owner investment. Some of the steps that you can take as a business to prepare for obtaining financing would include having some well-organized financial documentation. Many businesses use some sort of automation or software for that purpose. Good business credit. We have another video where we talk about the maintenance of good business credit for businesses. Talk to some of the other business owners and let's see what sort of experiences that they've had and draw upon some of your own experiences that you've had in the past for obtaining financing from whatever sources that you used. Another important thing would be to establish lender and investor relationships in your community industries. Sometimes that network that you're going to build locally could be invaluable to you in securing financing or perhaps even leads for that. And engage the services of capital acquisition consultants. Organizations like the Sentinel Group can help you find sources of financing that may not be readily available or well known, perhaps to businesses such as yours. We wish you all the success in your quest to obtain financing, and we want to thank you for your time. This has been a presentation by Sentinel Consulting.